Good morning all and welcome to today's webinar. My name's Alex Makinson and I will be your presenter for today. Today's webinar is obviously Academies Finance Update. So if you're not here to talk about Academies, you're not here to listen about Academies, then you're on the wrong one. As always, I'm going to start this morning with just the usual housekeeping. Hopefully you can all hear me. And I'm coming through crystal clear, but just in case, just please make a little bit of a note of the access code and webinar ID numbers that are in front of you now, and you can dial in through the telephone just in case you have any audio issues. This morning is a live webinar, so we could have some technology issues. Let's hope not, fingers crossed. We are due some. We've had a few webinars which have gone perfect. So at some point we know there's going to be a disaster coming, but let's just hope it's not today. We will be recording the webinar and we'll send out a copy of the slides as well after the webinar. So don't worry if you do lose your connection and something happens, we will send everything across to you. We do have a chat function in the webinar. You are welcome to ask any questions. Being a typical bloke I am, I do struggle to multitask. I'm not great at multitasking, but if you ask a question, we will either try to answer it at the end, or I'll come back to you after the webinar with any answers to the questions you have, but you are welcome to sort of ask them in the function. You can also drop me an email. My email address is on the screen now, so please just jot it down, and you're welcome to ask me an email, send me an email, although all the questions via the chat function are confidential. As I mentioned, this webinar will be recorded and we'll circulate it shortly after the webinar itself. Now, I'm going to keep you for around about 45 minutes. If you've been on one of my webinars before, I always say about 45 minutes, but in the end, I always take the hour. Let's hope it's 45 minutes today. For those that don't know me, my name's Alex Makinson, as I said, and one of my areas of expertise is in education and academy trusts. I act for a significant number of trusts and academies, hence why I get the joys of speaking to you this morning. I'm a partner in Mitchell Charlesworth, and obviously one of our key areas is academy trusts and supporting schools. Now then, we've got quite a few things on the agenda. I say quite a few things, 4 things, but they're quite detailed, to be honest. We're going to talk about our 2023 benchmarking report. We're going to start off with that, go through onto our audit outcomes, talk about post-audit checklists, main findings and concerns, move on to pooling, so GAG pooling, pension pooling is what I'm talking about there, and then finally, just very briefly talk about the ESFA Frameworks. But the first thing to talk about, obviously, is the 2023 Academy Benchmarking Report. So I think this is our 11th benchmarking report. When someone told me it was our 11th, I couldn't believe it. We've been doing this for sort of 11 years, or certainly doing the benchmarking report for 11 years. We are one of the few accountancy practices that actually does benchmark academies and then provide the report. The full report can be downloaded from our website. It's there on the right-hand side. The web address, you can see that there, and you can download a copy of the full benchmarking report if you wish to have a little look at it. It is quite detailed, there's quite a lot of things in there, and I'm certainly not going to go through every single page of it today. Now, the benchmarking report covers over 330 trusts, would you believe? Well, it's actually over 320 trusts and over 2,400 schools. They are of all shapes and sizes, from SATs, primary SATs, to secondaries, to large MATs, to small MATs, to special schools, to every single permutation that you can probably think of is included within this benchmarking report. And we try to segregate out in certain areas so you can sort of see where you sit and where your schools and where your trust may sit, whether that be because you're a very small MAT, or whether you're a very large MAT, or whether you're a secondary or primary or mixed. You can actually benchmark yourself depending on where you sit. What I'm going to do when it comes to the benchmarking report today is I'm going to cherry pick a number of pages and just go through those pages with you. Certainly not going to go through every single one, just the ones that I think are of interest, the ones that I think you might be interested in more than anything else. And hopefully there's something in those pages that you want to have a look at, and then you can go through into the benchmarking report itself, download it, and maybe compare some of the things that your school and trust has done to other schools and other trusts, just to see where you are. So we're going to start with the key highlights of this year's benchmarking report. And I've extracted this from the report. As I said, it's our 11th annual summary, and it contains a lot of information about a lot of schools. So the first thing it sort of tells us is what's happening when it comes to the surpluses this year. So I think you'll be quite surprised that in spite of it being a very challenging year last year, and in spite of budgets being squeezed, virtually all trusts reported in-year surpluses. And I'm going to talk you through this this lovely little thing at the bottom in a few moments' time. But those surpluses have slipped backwards this year. So you can see from the right-hand side here, the in-year surpluses have gone down compared to the record surpluses that were reported in the previous year. So what we've done at the bottom here, we've tried to split it between SATs, so single school primaries, single school secondaries, and then MATs, and depends on whether you're deemed to be a small, medium, and large MAT. So I'm going to take each one of these and just talk you through what it's showing you here. So you'll see we've got 3 years on the left-hand side here. So primary SATs, for example, in 2020 reporting a sort of in-year surplus around about 25,000. That dropped last year to 14,000. And 2020, they've actually slipped. They're one of the few areas that have slipped into an in-year deficit. So the average in-year deficit for a primary was £40,000 for a SAT. If I take you to the opposite end of the scale, the large MATs, there's certainly been a slippage in the sense of in 2021, they had in-year surpluses of, would you believe, £1.6 million for large MATs. They've slipped down, but I don't know about you. I think I'd still rather be happy with an in-year surplus of £1.5 million. And what this does tell you that there is a lot of economies of scale happening within MATs, because the more you're on that right-hand side of the screen, the more you're towards the larger MAT, the greater the in-year surplus does seem to be. But naturally, there has been some squeeze on those surpluses. They've fallen backwards a little bit, but I don't think they've fallen backwards as much as we all probably expected. We did all expect it to be a very, very challenging year for academies, but it didn't seem to be that challenging. And we are talking here about the year ending 31st of August 22. So it's quite recent, to be honest with you. So let's move on to the sort of second summary page really here. And I'm going to cherry pick one or two things just to talk to you about on this page, because we've got some more detailed information coming. So most MATs have grown here. The average MAT now has 11 schools in, significantly up from the previous year, which was sort of 7.5. So naturally there's been growth in spite of the COVID year, in spite of challenges last year. Would you believe average income has gone up? And I've got a page on income a little bit later coming. So in spite of us thinking actually income hasn't grown, there has been a slight increase in average income. I'm going to talk about GAG pooling and talk about centralisation deficits a little bit later on. I think this is an interesting one. Last year, 70% of MATs expected to grow, and the year before that, that was 65%. We are now showing that 92%, practically all of the MATs in the country, are now looking to expand. They're looking to grow. They're looking to take on more schools. Maybe that's consolidation. Maybe that's joining with another MAT effectively. But that's a huge increase. Obviously, we had the white paper and then all the retractions again from that white paper recently. I do still think there is a very clear direction when it comes to academisation, and naturally a lot more schools are still converting to academies. But 92% is a very large number that are expecting to grow. But just to make sure, I'm going to launch a poll in a few moments' time. And a poll means that you can actually interact with me. Hopefully, you can click a button on the screen and to see whether actually that figure, that percentage is right and representation all compared to the people that are here on the screen or in this webinar. So hopefully this works perfectly. In a few moments time, my background staff will be launching the poll. So the poll itself is going to ask you a question, and it's going to say, is your trust looking to grow? And there'll be a number of answers. It'll be yes, we're looking to grow and we're looking to take on 1 or 2 schools. We're looking to grow and we're looking to take on more than 2 schools, and I'm probably talking about in the next sort of 12 months. No, we're not looking to go, or actually we're considering it, but we don't know yet. So hopefully we can launch a poll now. So hopefully the team in the background will launch a poll, and you can see the poll on your screen. Please do click a button. Sometimes, depending on how you're logging into the webinar, if you're logging on it through a mobile, unfortunately, it may not work. It's not 100% this. Well, it's getting there, really. So just click on. It's representational. It's all confidential. No one gets to see what your results are. I will share the total results with everybody. So I'm just going to leave that open just for a few more seconds, just to enable you to click that. Okay, team, can you close that poll and then share the results? Fingers crossed it will close now. All being well. There we are. Okay, so what is this saying? Well, it's certainly not 92% that our benchmarking report showed, is it really? So we've got 38% of those people present who clicked on the button, or were able to click on the button saying yes, they're looking to grow, and it's going to be probably less than 2. We've got a number, 31% of people saying they're going to grow and it's going to be more than 2. 8% no. Well, I think that 8% no is in line with the 92% that are looking to grow. So that's almost in line. And 23% considering. Now, one interesting point is the amount of growth. Historically, when it comes to the sector, growth meant maybe you were taking on 1 school or 2 schools in a year. Nowadays, trusts are not just thinking about taking on 1 or 2. They're thinking about taking on quite a number of schools, which is a heck of a lot of work. And it's very different from where that used to be many years ago. So team, could you possibly close that poll and we'll get back to the slides? Brilliant. Okay. So what else do we have on this slide here? Well, we know that times have been tough this year when it comes to certain costs. We know that we've got the energy price increases hitting us. We know that food inflation is going up dramatically. We know that salaries have gone up. And one of the big things for schools is the cost of supply has gone up dramatically. And that looks like it's continuing to go up this year. So we expect come next year, it will be even higher. So let's move on and talk about the sector in general, really. So I've mentioned small MAT, medium MAT and large MAT, and that's how we sort of distinguish between certain size of MATs. You can actually see here, what do we mean when we say a small MAT? Small MAT, 3,000 pupils, medium MATs are up to 7,500 and large MATs are more. So you can see where your MAT would fit, whether you deem yourself to be a small MAT or whether you deem yourself to be a large MAT, or whether you're a SAT, to be honest, a single own academy trust. Now I'm going to talk to you about this lovely table at the bottom, which is the number of academy schools, because I think it tells us an awful lot now. So here we are on the right hand side in 2022, and you will see that there are almost 10,000 academy schools and 8,600 of them are part of a MAT. And there are 1,100 MATs. There are also 1,300 SATs, single SATs, single schools. Now, if I take this SATs figure and I have a look at the same figure year on year, you can see a trend, which is the number of SATs year on year is going down. I think that's reflective over what's happening. That's reflective of what the RSC, dare I say that, is looking to do, which is not have any SATs, which is encourage you to join MATs, to become a MAT yourself, to grow, to take on more schools. What was a little bit surprising in this, and it's only a little bit surprising here, is the number of MATs has actually fallen. So you can see on the previous year, there's 1,198 MATs, 1,191 this year. So whilst we've got more academy schools, and that's certainly gone up this year, there's actually been a lot of consolidation, lots of MATs coming together. So whilst we've got more schools becoming academies, the number of MATs has dropped down. I think that will continue as consolidations happen, and you will see that 2-3 school MATs start joining together to become bigger MATs, really. So it wouldn't surprise me if we're sat here next year and the number of MATs again has gone down. And I certainly expect the number of SATs to have gone down, but I do expect the number of academies to have gone up. So let's move on to the in-year surpluses. Now, when I talk to trustees every year and I go through their accounts, sometimes it's really hard to explain in-year surpluses to them, because all they do is they see the SOFA, the profit and loss account, as I say, the income and expenditure account, even though the SOFA is the statement of financial activity. And it can paint a very different picture to what the true in-year surplus is. And I've given an example on the screen here of what I mean. So let's just say I'm presenting to a trustee here, and the SOFA shows an in-year deficit of £600,000. And naturally, the trustees could be very upset and go, look, we've got an in-year deficit of £600,000. We're very unhappy about that. What's going on? But the reality is there's lots of accounting adjustments that go on here. There's lots of things that are presentational, effectively. We all know we've got depreciation that comes in. We've got the horrible pension service cost. So all that happens, it gets added to your pension scheme. You don't actually pay that service cost, but the accounts have to show it there. And then we've got capital income. So on this example here, actually, this trust has a true in-year surplus of £450,000, even though the SOFA is showing a deficit of £600,000. And that's just about understanding those accounting adjustments to show exactly what is the true performance of the trust once you add back all those key items, i.e. depreciation, pension service charges, and capital grants. And if you're lucky enough to have SIF bids, obviously that can skew your SOFA quite dramatically. But where are we when it comes to the in-year surpluses, really? Well, from that previous slide over the summary, we can see there has been some significant in-year surpluses. If I put the primary SATs aside, because they're showing a deficit, everyone is still showing an in-year surplus, and some sizable figures as well for the year. Medium MATs, so that's less than 7,500 pupils. In-year surpluses of £372,000 on average. It's quite a significant figure. So whilst we all acknowledge this year has been very challenging, it's not as though trusts haven't had surpluses. Most of them are still showing surpluses for the year. I appreciate individual schools' positions might be very different, but overall, those surpluses are still being shown. Let's move on to deficits now. One of the interesting points, and one of the slides I've got on the screen here, is about trusts with cumulative deficits. So those trusts that are running a deficit position. And we all know how hard it is to balance the budget. We all know how hard it is to fill in our BFRO and make sure that we're reporting a surplus, because we know what happens if we report an in-year deficit. Well, you can clearly see what the trend is now over the years. The number of trusts that are reporting cumulative deficits has dropped down quite significantly. Clearly, the DFE, ESFA have been focusing on those trusts, been working with them, trying to pull them down, trying to put them back into a balanced budget position, and it's clearly worked, because there are practically a very small minority of trusts now that are showing reserves of a deficit position. And you can see it's dropped quite a lot over the few years. And remember, we've got COVID years going on here. We've got the 2 COVID years, 20 and 21. And the pre-COVID year was quite high, 8.2% of the trusts that we obviously benchmark here were showing as deficits. That's dropped down now to less than 1%. So quite a significant movement when it comes to deficits. So let's move on from deficits to reserves, and to reserves of academies, and where do we sit now. And we separate these out between primary SATs, secondary SATs and MATs, and then one of the other reasons for showing the primary SATs and secondary SATs separately as well is it almost gives you a flavour for where the individual schools may lie, as well as the MAT overall position, really. So you can see when it comes to primaries, the average free reserves now is just shy of £350,000. Still not bad for a primary. If we get into secondary, £965,000 free reserves, and the average MAT now, £3.1 million. We've still got some significant cash, significant reserves being held in schools, and it has gone up. Now it's pretty flat, I would say, across the primary mark. It has gone up ever so slightly. The secondary, there's definitely a trend there, and if you look at the MATs, gone up quite significantly, isn't it there, really? So again, in spite of it being a difficult year, reserves have gone up. I'm going to move on to top slicing now, and it's always a very interesting slide I talk about here. I often have conversations about top slicing with a lot of my clients, especially the ones that are looking to grow and looking to entice new schools to them, because obviously top slicing comes into that consideration. And I'm going to give a sort of an example of someone I spoke to the other day, which has just converted to an academy and going to join a trust, really. And I said, Alex, I've decided on which trust the school's going to join, lots of reasons, but I'm really happy because their top slice percentage is really, really low. And I said, okay, what's your other option? Well, there's another trust around the corner. They offered everything as well. They were really good, but their top slice percentage was really quite high. I didn't like that, and therefore I've chosen to go with a lower top slice trust. And I said to him, what do you get for that top slice? And he hadn't got a clue, to be honest. So he focused on one thing, which was the percentage, without actually realizing what you get for that percentage. And that's the most important thing, because it really doesn't matter what the percentage is, but it does matter what that trust is offering for the percentage. And I'll talk you through some of these percentages now and exactly what I mean. So you can see where most trusts are on the slide. Most trusts sit on the 5% top slice percentage. But you can see that's dropped down this year. 60% of trusts were charging 5%. Only 50%, only half are now charging 5%. And there's been a big increase in the 6 to 7% mark. So that's practically doubled in the 6 to 7% mark. And these ones here are dropping down. And even the 8% mark, which I gulp at, has gone up significantly. But in my example with that conversation I had with that head teacher, because he wanted a sort of 4% rather than going up to here to a 6 to 7% one, is actually the 6 to 7% trust was actually offering lots of things as part of the central services that actually would have saved him money in his budget. Actually, from a financial perspective, his school would have been better off to join that trust at a higher top slice percentage than the cheaper one. Why? Because they offered things like training and staff training, which means he didn't have to pay for that in his budget. It all came out of the top slice. It all came out of the central service pot. So it's really quite key on what you're getting for the top slice rather than actually what the top slice is. Now I'm going to launch another poll now about top slicing. So my team in a minute will launch a poll. So my question to you is, after seeing that, after understanding that actually it looks like top slicing is increasing, are you looking to increase your top slice percentage in the future? Is it something you've spoken about? Is it something you're going to speak about in the future? Is it something you're going to go back and potentially discuss? So hopefully we can launch the poll now, and my team in the background can put it on the screen, all being well. Brilliant. And again, you can just click, are you looking to increase your top slice percentage, or potentially think about it, yes, no, or maybe you're considering it really there. So just click on the screen if you can. I'm just going to leave that open just for a few more seconds, and hopefully we can close that poll now and share the results. Fingers crossed. And there we are. Okay, so 45% no. So almost half the people in the room, should we say, are saying no. 18% yes, and 36% potentially considering. I do think there's going to be a lot of movement in top slice going forward. It is an interesting area that people discuss an awful lot. And when you're trying to attract schools, clearly it's a big thing that they look at. But the one thing that is happening at the moment is people are looking at what they're getting for their top slice. Does the top slice cover all the costs for the central services and the central team? And there has been that movement towards increasing that top slice percentage. And remember that top slice is just one way of actually funding your central team here. It doesn't need to be percentages. It can actually be fixed fees. It can actually be relating to pupils. Percentages does seem to be, or percentage of income does seem to be the norm, but it certainly doesn't have to, and every school and every trust can be different. Okay, team, can you just close that and we'll get back to the slides? Thank you very much. Okay, moving on now onto centralisation. One thing that we found this year is the number of trusts that are centralising their functions has increased quite significantly. And you'll see from the left-hand side, which is the fully centralised. This is where trusts are fully centralising their finance system. So everything to do with their financial system being centralised, not being done on a school-by-school basis. And you'll see now 55% of trusts are now doing that. If we segregate that out, which is what we've done in the middle here, you'll see that actually, when it comes to larger trusts, virtually all of them centralise. And if you go down to smaller trusts, a little bit less centralised. You can see some partial centralisation going on. This is where I suspect you've got school business managers, bursars still processing certain things, still maybe logging invoices, paying bills locally at individual schools, rather than having a central team do everything really. But there's definitely a trend for more centralisation, and the reason for that is because of the economies of scale and the costs of doing so. We are also finding that a lot of central teams now are taking themselves out of the schools. So a lot of central teams are actually no longer based at the schools, and maybe they either have their own central location, which is around the corner from one of their schools, or completely different, or maybe their own building separate on a separate site at a secondary school or something like that, really. But there is an awful lot of centralisation going on. So let's move on to financial performance and income. Would you believe it that yes, core funding has gone up? It has gone up. The increase has been ever so slightly. You can see from the graphs, doesn't matter where you sit, it's pretty flat. It's gone up ever so slightly, but you know, we have to acknowledge it has gone up. It has been challenging, but there is an increase. We know that the government has committed to more funding in schools and returning funding to 2010. If we were able to get this to 2010, I think we'd find a little bit of a trend that actually has gone down and then gone up ever so slightly. But it looks like it is going to go up again next year. Let's wait and see what happens. Let's see what comes. And I only believe these things when we actually get it, when we see the money coming through. But we do have to acknowledge that there has been an average GAG income per pupil increase. And it doesn't matter where you sit, whether you're primary sat, so whether you're a primary school down here, average being 4,200 per pupil, secondary 5,400, and the MAT obviously just shy of £5,000. And it has been an increase year on year, ever so slightly, on every single one of those. So I think reluctantly, we probably have to accept there has been some increases of income, but we all know full well that has been offset with a heck of a lot more expenditure because of everything that's going on. Let's move on to trading income. This is a really interesting topic at the moment. Over the last few years, when it comes to COVID, trading income fell off the cliff. Obviously, no one could really generate any trading income. You couldn't open things up. You couldn't sell things. You couldn't do things. Trading income was virtually non-existent during COVID. However, it's come back, and it's come back with a vengeance for trusts. Our data, as it clearly says here, is showing that MAT trading income grew by 36% above pre-COVID years, because we're talking about comparing pre-COVID, because obviously COVID was down quite dramatically. And would you believe some of those are reporting six-figure trading incomes now? That's significant sums of money really here. And you can see here the average income per people for trading depending on where you sit. And we've got a lot of COVID years going on, hence why it goes up and down quite a bit here. But you can see where the trading income is coming from. Now remember, trading income can be very, very problematic for an academy trust and school. Why? Because if your trust has more than £80,000 worth of trading income, then that income and any profit is taxable. It's not educational income, and therefore if you are making profit from trading income and you report trading income of more than £80,000 in a year, then unfortunately there potentially is a tax bill to be had. However, that tax bill can be mitigated, and that's why we often talk about trading subsidiaries, because having trading subsidiaries where all the trading income then goes in can help mitigate, reduce, if not completely mitigate, all the tax liabilities when it comes to trading income. And I think what we will see going forward is a lot more MATs as their trading income increases, as they look to generate more income elsewhere, will start utilizing more trading subsidiaries. And what's the reason for those trading subsidiaries? Well, there's a number of reasons, including things like pension costs, because you may choose not to follow the LGPS and you may choose to follow auto enrollment to save you money. But equally, if you're making profits and use a trading subsidiary, or because of some lovely little quirks, you may not have any tax to pay within the trading subsidiary. So let's move on to staff costs. And perhaps surprisingly here, staff costs have remained relatively static. You can see the average staff cost per pupil. Obviously, it's different depending on where you are. Some of them have gone up, but they've not gone up dramatically, to be honest with you. We had an announcement, didn't we, in July 22 to say that pay rises were going to increase the pensions, and we've still got some negotiations going on there when it comes to salaries. So clearly staff costs are going to go up in the future. Let's hope there's more income to compensate for the extra staff costs. Let's wait and see. But you can probably see here that actually some staff costs have gone up, but they've not been overly significant. Talking about some specific staff costs now, in front of you, you've got the average CEO and CFO salaries. And I'm going to talk first of all about the CEO/head teacher salaries. And obviously there's some significant movements between primaries and maths. Now you'll all remember a number of years ago that the DfE ESFA made it very difficult for anybody to have a salary of more than 100,000. They said if you have a salary of more than 100,000, there's lots of disclosures in the accounts. They almost wanted to put you off paying certain individuals more than £100,000. Well, I don't think it stopped anything, because clearly now when it comes to a MAT, the average is far in excess of 100,000. 127,000 is the average CEO salary in a MAT. For the first year ever, the average salary in a secondary SAT, so just a single secondary, has now exceeded £100,000. Primary, naturally, a little bit lower there and still a bit off the £100,000 mark. But it has gone up. We all expect it to go up again. If we move on to the CFO remuneration, now there is a skill shortage, would you believe, in the academy sector for experienced and skilled CFOs. Doesn't seem to be the same when it comes to CEOs. You see lots of head teachers becoming CEOs because obviously they are very, very skilled in education, and therefore they can guide trusts through and can easily become the CEO. But it's much harder to find CFOs. Why? Because you're talking somebody with a lot of financial knowledge and somebody that has the educational knowledge as well to bolt on to that financial knowledge. That's quite rare. So there has been some increases in the CFO remuneration. Clearly, it's still a lot less than CEOs, but some sharp increases. And we have to take the secondary SAT one. We're now at 67,000 being an average, and the MAT 72,000. And that's been a sharp increase on the previous years. I think that just reflects the position that actually good CFOs for academy trusts are hard to come by, and one would expect that that salary will start increasing again this year. Going to move on to pensions now. Now, if you recall from your accounts, your financial statements at the end of August, something happened this year which was unusual when it comes to pensions. Now, when I talk about pensions and I talk about the balance sheet for Academy's financial statements, the elephant in the room is always the massive liability that's on that balance sheet for the LGPS, the Local Government Pension Scheme. And I always tell trusts, don't worry about that liability. No one's going to come knocking on the door for that millions of pounds that's reported. Call it an accounting adjustment. Call it one of those things that we have to include in there, although we wish we didn't, to be honest. Well, this year, that figure or that liability that is normally shown went through the floor. It went down dramatically this year. The movement was humongous when it comes to the LGPS pension scheme liability. We're talking millions of pounds worth of movement in a year. Why? Because August 22 was a good day for the markets. It was a good day for pensions. August 21, I think, was an appalling day. August 20 was also an appalling day. So there was lots of movement in the pension markets that day. As a result, the liabilities were much better, really, and they came down. So you can see in our graph on the left-hand side here, the average LGPS pension liability per pupil has shot down. £3,200 in 21, 472 in 22 for primaries. What a heck of a drop. Lo and behold, if I had a crystal ball over where would we be at August 23, I suspect that figure will go back up again, I'm afraid, and we'll be reporting large pension liabilities and large movements again. The right-hand side of the screen is all about the LGPS employers' employers' contribution rates. So you can see here that 32% of trusts are paying a contribution rate of less than 15%. And if I take you to the higher end, 28% of trusts are paying a contribution rate of more than 22%. That's a huge variation. And the costs are quite dramatic when it comes to those rates. And we've given an example down here, which I'll just talk you through. We've got a large MAT in Teesside paying 14.6% employers' rate on all of their staff in the LGPS, compared to a standalone trust in Leicestershire paying 27%. So one trust paying 27% as an employer contribution and another trust paying 14% employer's contribution. And based on that, the difference is around about £124,000 a year. These are huge numbers, really. And it's quite shocking that those rates are very, very different when it comes to those trusts. Naturally, you can't do anything about your local government pension scheme other than hoping that the people are looking after it very well, and actually that deficit is going down. And if that deficit keeps going down, then obviously the rates that you're contributing will go down naturally. But the difference between the rates seems to be growing. I think I'd be rather upset if I was paying a 27% contribution rate. It's not really fair that somebody else is paying a 14%. Naturally, that impacts on my budget quite significantly. Okay, so within our benchmarking report is a data analysis sheet for all of the types of trusts, so small, large, SATs, MAT, social scenario, where you can benchmark your figures. So you can actually put all your figures besides the averages and see where you sit. You're more than welcome to download the report, as I said, and just see where you are. So you can see on this screen here that actually, if we took staff costs as a ratio of total costs, the highest is 83%, the average is 74%. Where does your trust sit? Are you closer to the higher or are you closer to the average? And you can do that across a number of things, from all of your income measures to all of your cost measures, to your balance sheet items and all your surpluses and reserves and bank balances really here. So hopefully that's given you some information on the benchmarking, and you may choose to download the full report, which is free, I must add, and use it or show it to your trustees and see what it tells you. Okay, let's move on. So the second item on the agenda is audit findings. And the ESFA, would you believe, are always 12 months in arrears when it comes to the audit finding and publishing what's been found. So the good thing is that 97% of trusts submitted all of their accounts to the ESFA on time. 3% didn't, and on the average of why was always to do with the trust closing, or the vast majority was to do with the trust closing, and as a result they were late because the trust was closing, and there's lots of things to sort out when the trust closed. 0.5% of those accounts were qualified. What does that mean? It means they were fundamentally wrong somewhere. There's something going on. The auditors were not happy with the financial statement, but that is a very, very small percentage, to be honest with you. The main reason for those was the LGPS valuation. It could be that for some reason a valuation couldn't be obtained, or there was something happening at a valuation, and some treatments to do with land and buildings. It could be that unfortunately land and buildings haven't been transferred across from local authority correctly, but there's clearly some issues around those two areas. When it comes to the modification, so you remember the regularity report is all about compliance with the Academy handbook. Have you complied with all those lovely rules and regulations in the handbook, or did you unfortunately fall foul of doing something in there, and as a result you had to have a modified regularity opinion? Well, just shy of 8% had a modified opinion and unfortunately didn't do something in accordance with the account direction. So with the Academy Accounts handbook. What were those issues? Management accounts. Management accounts not shared with the board or not sufficient, i.e. missing some of the things that you are obligated to present. Financial issues, not reviewing certain things like debtors, creditors, or bank reconciliations. There's an obligation to do so. ESFA deadlines, you missed something. You missed a deadline. You forgot to submit the benchmarking, sorry, the BFR report, or you forgot to submit the land and buildings report, or it was late. That results in a modification. And I can't believe I'm still talking about this, but related party transactions. Huge amounts of people are still missing the related party transactions. This specific one here is all about the approval of related party transactions for those that are above £20,000. But lo and behold, we also have the ACT cost policy for related parties not being adhered to too. And they are still here, and every year I mention them, and every year they're on the list. So clearly, there's issues still around related party transactions when it comes to trusts, because it's making a big part of all of those modified regularity opinions when it comes to the accounts. One of the new things that have come into this year is pecuniary interests not being in place and not being published on the trust website. I know what a pain in the backside it is to report them and to update them, especially if you've got movements in trustees frequently here, but unfortunately it's a requirement. You have to publish those interests. They should be on the trust website and they should be up to date, and if they're found not to be up to date, you may have a modified regularity opinion and be part of that sort of 8%. Moving on to the post-audit checklist. I always bring this one up because December is a very busy month, and then you get into January when it's the Academy's accounts return. You found that, you take a breather, and then you forget about all the other things that need to be done. And it's quite common to forget about all the other things that have to be done after all of that, and it gets missed. So what are those forgotten things? The first thing is submitting the accounts to Companies House. You've submitted them to the ESFA. That's box number 1 ticked. You've done the AAR to the ESFA. That's box number 2 ticked. But have you done a submission to Companies House? That has to be done by the 31st of May. Now, most accountants, auditors do it all at once. Some do not. If you're one of those that sits in the categories over, you do not, please make sure it's done. If you don't, there is a fine and penalty. You might pass it on to your accountants and your auditors, but there still is a fine and penalty. It doesn't look good. The second thing, the financial statements must be on the trust website. Now, it was delayed the previous year. You had to the end of February. It's back to the end of January. We're now in March. Would you believe lots of trusts still miss this, still get it late, publish them late, or forget to do it at all? So make sure that your accounts are on your website. When it comes to your audit for next year, the first thing the auditors do is check that last year's accounts are on the website. Corporation tax return. Now, whilst you probably think that all academies are effectively exempt from corporation tax, well, I mentioned the trading income issue. Well, if you have trading income more than £80,000, you may have a tax bill. The reality is academies should be completing a corporation tax return unless they've got a dispensation from HMRC to do so. Most do not. And whilst that return might show a lot of blank numbers or there's no tax liabilities, there are some pages that show what are the assets and the liabilities of the exempt charity, the trust, and what is the trading income. And if you have that trading income more than £80,000, you're making profits, tax to pay. That's due by the 31st of August 23, so you've got loads of time for that, although most accountants do it around about now. If not, it's already done for your trust. And then we've got the ESFA and the National Audit Office notifications. If you were one of those trusts that unfortunately had a qualified audit report or a modified regularity report, then there is another form to submit in relation to the ESFA and the National Audit Office. You have to do that. That is often missed, but it should be done, and that should be reported as well. Moving on now to the ESFA funding audits. We are hearing about a lot more funding audits coming from the ESFA. A lot of our schools and trusts have been contacted and advised that they're going to get a visit. So if you've not heard of it, if you don't know what it is, this is what it is. This is where that actually the ESFA, DfE come in to check that actually your census data, your reporting data when it comes to free school meals, when it comes to pupil premium children, is all correct. Why? Because this results in your income. If this isn't right, your income isn't right. So this audit is all about making sure that all those pupil census numbers and data is correct. I'd say 9 times out of 10 it is, the schools, but they are still finding errors, they're still finding problems, and as a result, that's resulting in income adjustments. What factors are they looking for? Obviously, there's the obvious points over pupil premium and free school meals. Oh, I've clicked a slide too far. It'll come back. There we are. But they're also looking at EAL, high value courses, and looked after children issues. So just make sure that if you are chosen, you've got all of that in hand, and you've got all the evidence to back up where all the information comes from. Don't be surprised if you are chosen. It doesn't mean you've done something wrong. It doesn't mean there's an error or there's a report. A lot of this is random testing. A lot of this is just random notifications. This is very different from an SRMA visit. This is purely just looking at your income streams and looking at where the census data, the numbers come from when it comes to those income streams that then result in your GAG, that then result in your payments to you. Okay, let's move on to GAG pooling and reserve pooling. I often talk to trusts now about GAG and reserve pooling, and I'm going to change the word GAG pooling and I'm going to put income pooling here. And I'm going to talk about the two different things. It's a very interesting topic. It's one that's quite hard normally for a lot of governors, if you still have local governing bodies, to get their head around, because they almost try to see their individual schools as individual units and their reserves or their income as their own, rather than seeing the bigger picture, which is we're all part of one map, we're in it together, and we should be talking about all our income and all our reserves together. And this is what GAG and income pooling, reserve pooling is all about. Now, GAG pooling, reserve pooling, why are they different? Reserve pooling is just that. It's you're pooling your reserves, and it might be that you've got a deficit either at one school and some surplus at another school, or you've got a deficit in central and surpluses across all of the other, and you're effectively going to pool all your reserves into one place effectively, or move things around, so you're just effectively pooling the reserves, the surpluses you have carried forward effectively into one pot, or playing with the reserves itself. That's very different from GAG and income pooling. GAG pooling is when you turn around and go, actually, all of the GAG is going to come in centrally. And then we are going to dictate what individual school budgets are. So in other words, whilst income comes in for school A, based on the number of pupils and the GAG, they may not get all their full GAG funding if the trust central team or whoever's deciding decides actually they don't need it. So the income can be directed to other areas based on need. You're putting all of the GAG into one pot and then divvying it out. It does make things a little bit easier when maybe you've got a school over there that's doing really well, that has surpluses every year, and another school over here that's quite challenging, that needs more money, but it doesn't make sense to obviously give them any money. So you can do certain things when it comes to GAG there. But we're not just talking about GAG, we're talking about income pooling. You can pool lots of income. You can even pool, it's a common misconception here, DFC. DFC, devolved form of capital, can be pooled. And you can put it in one pot and then spend it. There's certain things that can't be pooled, and I'm sure you probably know which ones they are. Pupil premium rings a bell here, that you can't pool that because obviously that has to be spent on those pupils effectively in that school. So therefore, you shouldn't be pooling that. That should go directly to the school, but it might be that you pool it and then pull it 100% allocating it across. When it comes to GAG pooling is on the increase. And it's still a minority of trusts that do it. 23% are doing it now, but it was 14% the year before. And large trusts, it jumps up to 31%. So for large trusts, it's going up. And does seem to be this trend of increasing GAG pooling and increasing reserve pooling now. Now, I'm going to launch a very quick poll again here. I'm conscious of time, so I'm going to move on quite quickly here. But the poll is going to say, are you considering any form of income GAG or reserve pooling? Yes or no? So hopefully my team in the background can quickly launch a poll and it will come up on your screen. Again, click the button, yes or no. Are you thinking about income or GAG pooling, reserve pooling? Hopefully you can click on it. Hopefully you can see it on the screen now. I'll leave it open just for a few more seconds just to make sure. Okay, team, do you mind closing that and sharing the results? Okay, and the answer 70-30. I think that's quite representational over the number of trusts that are actually GAG pooling, isn't it, really? If we say that large trusts are up to 30% and, you know, all trusts 23%, well, if we follow that 30% of the people here are thinking about GAG pooling, well, that's an increase from 23%, isn't it? So I do think we're going to see a lot more GAG pooling going forward, a lot more reserve pooling going forward, especially when there's problems at maybe one or two schools and we need to rebalance either budget or reserves. So thank you, team. Could you please close that poll down? And we'll crack on. Okay, moving on now to LGPS and GPS rates. I said rates, I put pooling. I'm going to change my mind and not call it pooling anymore. So the first thing is teachers' pensions. We all know full well that there is a rate across the country, it gets agreed. No pooling is allowed, I'm afraid, because it's a set rate. There's no benefit. All it is that you get a rate. However, you can combine certain things when it comes to pension schemes. We're getting now towards the end of the tax year, so we're getting towards the end of the payroll year end, and at some point you will have to complete your end of year certificates and submit them to the teachers pension scheme online through the portal. Now you might have a lot of schools within your trust. There is nothing to stop you combining your end of year certificates into one. If you combine your end of year certificates into one, it saves an awful lot of time. Why? Your auditor has to audit every certificate. So if you're a MAT with 10 schools in it and you don't combine your end of year certificate, that's 10 individual end of year certificates that need auditing, and your auditor has to test each of those 10. There's certain rules and regulations and percentages that have to be tested, certain number of items have to be tested. If you have one end of year certificate that covers all 10 schools, there's only one certificate to be audited, and the number of tests is a lot less because it's a percentage based on the number of certificates. and a number of teachers in there. So you're doing a lot less testing. What does that mean? It saves time, it saves money. One thing to note when it comes to the end of year certificate, just because I'm mentioning it now, is there has been a change to the contributions email. So you remember, normally, sometime end of April, beginning of May, you receive an email from the Teachers Pension Scheme to say, we have received from you this amount of money in relation to your employer's contribution for the teacher's pension. That email will not come to your email address now. Instead, it will be sent via your portal, the Teachers Pension Portal. The interesting point is you'll get an email to tell you what's there, which is a bit bizarre because you might as well have just sent the email in the first place, really. But what you'll have to do is go onto the portal, download that portal email and send it to your auditors along with all the payroll records and the end of year certificate that you've submitted. So don't miss that. Please download it. Slight change this year when it comes to that email. On to the LGPS pensions. Combined rates, pooling, if I want to call them, are allowed. You can combine all of your rates. You all know that all individual schools have an LGPS rate, but if you choose, you can go with a MAT rate. That combines all of those, changes them and gives you a MAT rate. Naturally, there are pros and cons to those rates. It could give you a lower overall trust rate. Maybe you've got one school that's got a really high rate, but 3 schools have got a low rate, combine it, and actually overall, it might bring it down. Naturally, it's easier to apply to budgets. All you've got to worry about is one rate and not loads of different rates. So budgeting has become far easier when you've just got one combined rate for the LGPS employer pension contribution. Obviously, it's not all greener. On the other side, rates could increase. You could find that actually rates are increasing and your combined rate is increasing, not going down. And equally, if you've got schools coming into your trust, if your trust has decided on a combined rate and that school is having a much lower rate and a company got a much lower rate, it's a negative to them. Why would they want to join your trust if actually their employer's rate is lower than your overall trust rate? It would mean that they are impacting their budget and it's costing them more money to join your trust and to join that rate. So there are pros and cons to consider when it comes to combining the LGPS pension. I'm conscious of time, but I've got 2 minutes now. 2 minutes just to go through the ESFA framework. The ESFA are conscious that costs have gone up. They're conscious that costs have gone up across 2 really big areas, energy and catering. And as a result, they're guiding you towards certain things. There's a number of webinars out there with regards to the ESFA approved frameworks. The framework effectively is where you can go into the website of the ESFA, put certain information in, and it'll direct you towards certain suppliers that could, and I'm using that word could, save you money. It's certainly worth looking at. So there's lots of webinars that they've been putting out there in relation to certain things. So catering is one of them, and they choose to effectively support ESPO. Forgive me, I don't know what that acronym stands for, but they are a provider of catering services throughout the UK, and they cover certain things. I'm not promoting them over something else. This is coming from the DFE ESFA here, and they obviously have benefits. But what they're saying is, at least go onto their framework, at least look, at least see, can these people offer you better value for money when it comes to cost, knowing that your costs are going up in certain areas. The same thing applies to energy. They promote West Mercia energy, and I know a lot of trusts have benchmarked West Mercia and found them to actually be more expensive, to be honest, but you have to have a look and see. The frameworks are on the screen. You can go onto the website and you can go into the framework and follow it through. There are not just energy and catering items. There's lots of different frameworks on here that you can follow to see who could be the suppliers in these areas, who it's worth contacting to see whether actually there are some savings to be made and whether there's something in there for you. According to my lovely timer, I'm bang on 12 o'clock. So for once, I've met my deadline. I did say it'd be 45 minutes to an hour. I'm bang on an hour. Hopefully, you found that interesting. Hopefully, there was something in that webinar that you got out. I do encourage you to download the benchmarking report because there's so much more in there. I could have spoken for hours on the benchmarking report and even given you some examples on certain things. Feel free to download it. Feel free to drop me an email if you've got any questions, and I'll come back to you very shortly if you do. Thank you very much. Enjoy your day, and I'll speak to you again shortly. Many thanks.